Joining us here at Post 9, DataTrek Research co-founder Nick Colas is with us. Great to have you back. We were just referencing your work over the weekend and whether or not the VIX is instructive on any of this stuff regarding the Fed. What's your take?
Yeah, no, the VIX is right now extremely low. We're talking about lows back to the pandemic crisis. And that's unusual because the VIX usually averages around 20, and we're trading 16, 17. That says markets expect very little volatility over the next 30 days. On the one hand, never short a dull market. We've got a dull market, so we should trend higher. But the market's expecting rate cuts later this year, and rate cuts just don't happen when the VIX is below 20. Going back to 1990, there's been 6 rate cycles on the downside. Only 2 have started with the VIX below 20. The rest have all been above 20, above 30 in most cases.
Are you of the belief that single-day options activity has rendered the 30-day VIX less relevant overall as a tool for all kinds of storytelling?
I'm just too old to say the VIX is broken. We've heard that for so many years, and the VIX still does a very good job. Look at today's tape. Very little volatility. The VIX is below 20. That fits.
Right. So you're not buying the rate cut picture. And you haven't, I don't think, been that constructive on earnings or the earnings outlook so far, right?
Yeah, the earnings outlook, this quarter is doing better than the last couple of quarters. We were seeing very low levels of beats and beat amounts in the last 3 quarters and a declining cadence. We're back to somewhat normal, like 5% beats. That's pretty good, but analysts are still looking for record earnings by Q4. That's just not going to happen.
You usually have a good read on sentiment, Nick, whether it's through Google Trends or just what is on people's mind. There's been a lot about how negative sentiment has been around stocks, especially at the institutional and hedge fund level. What about retail, and what does that tell us about where we go?
Retail seems to be a little more constructive, and particularly not just on stocks, but on the economy as a whole. If you look at Google Trends for all kinds of labor market indicators, the worker, the person, going 9 to 5, is still very confident in their ability to get a new job, to work remotely, to negotiate wage increases. All those things are still kind of stuck where we were even 18 months ago. That hasn't really changed.
In other words, as long as there are job gains and the employment picture is strong, then consumer holds up and equity market holds up?
That's basically the story, yes. We've been sitting with rate cuts now for over a year, and the story's been largely the same. The only difference is earnings are now negative year over year and will be so for the next quarter as well. So it hasn't really helped corporate America's profits, but in terms of overall outlook, economic outlook, GDP should come in 2.5% on Thursday. So things are still looking okay.